There are more than 1000 models of car, but when you buy a car, eventually you come down to maybe 2-3 models. अब 1200 या 1000 कार है, उसमें से आप नहीं बोलते अरे कौन सी खरीदनी है. You don't sort कि हाँ कौन सी बेस्ट है methodically, and you select कि मेरा बजट इतना है, माइलेज मुझे ये देखना है, ये ब्रांड है, and eventually you come down to 2-3 models और उसमें से आप select करते हो. और once you select, you never say कि अरे गलत select कर ली. But when you come to mutual fund, the way we buy or the way we see mutual funds is completely different. हमको तो सिर्फ एक ही पता है रिटर्न्स, यू जस्ट सॉर्ट. अभी आप सिर्फ सॉर्ट करोगे तो डेफिनेटली बहुत सारे फंड्स आएंगे एंड यू विल गेट कंफ्यूज्ड. सो देयर हैज टू बी अ सर्टेन मेथड गेट इनटू म्यूचुअल फंड.
What is that method and what are the 4 questions? So, car is a good example. Right. Car I can connect to. I can see I like SUV. I like exactly color. I like exactly. I want this is my budget. But mutual fund is something that people don't relate to like how they relate to cars, right? So, what are these 4-5 questions or things, factors that I should consider or any investor should consider to select their first 2-3 mutual funds? So, I have large cap, mid cap, small cap. Pretty straightforward. Large cap is in stable large companies, mid-sized companies, small company. And suddenly I have a fund called large cap and mid cap, and then I also have a flexi cap. So flexi cap, I can have access to all the 3 kinds of funds. Okay, how do I sort that confusion? So if I can have access to all 3 categories of fund in flexi cap, then why should I go individually?
Whether it is NFO or whether it is existing fund, there exists a list of good funds, list of bad funds. Same way there exists a list of bad NFOs, there exists a list of good NFOs. Small cap, they've still made good returns. People who have invested in large cap also, they've still made good returns. In fact, mid cap, small cap returns are still higher than large cap from 2008. So then you need to compensate of getting the timing wrong with the time. Timing and time can compensate each other. So if you get the timing right, maybe time is not so important to make good returns. You can make quick returns also. But if you are getting your timing wrong, then at least get your time right. They complement each other. Both these things come together. You get your timing right and you have good time also. I mean, then wonder happens.
Hello, welcome to another edition of This or That. This is Bhartendra Singh. Today our guest is Mr. Niranjan Awasthi. Niranjan is a Senior Vice President with Edelweiss Mutual Fund. He has over 17 years of experience in mutual fund industry. He looks after product management, marketing and digital innovation at Edelweiss Mutual Funds. We'll try and cover market outlook, different types of mutual fund and investing behavior that investors should consider.
Thanks for having me, Bhartendra.
We'll start. I always start from absolute basic questions, and mutual fund is simple. You invest in equities, you invest in fixed income. But if I open any mutual fund app, it becomes extremely overwhelming. There's so many mutual funds. There are 36 different categories. Why do we have so many categories of mutual fund? And how do I navigate? Like if I have to select my first 2-3 mutual funds, how do I go about it?
See, I keep getting this question and I keep saying that we overemphasize on this point of having too many mutual funds. Let me give you some examples, right? BlackRock, world's largest asset manager, runs more than 1000 funds. More than 1000 funds. हमारे तो पूरे इंडस्ट्री में 1000 funds नहीं है. The second reason is, if you see mutual fund, the beauty of mutual fund is an investor who wants to invest 100 rupees also can invest, whereas an institutional investor who is investing 10,000 crore also invest in a mutual fund. So the needs will be very different for a person who is investing 100 rupees to a person or an institution who is investing 10,000 crores of rupees. So risk appetite would be different, taxation needs will be different, lot of other things. And mutual funds cater to all these kind of clients. So in fact, if you ask me, this number will keep increasing. So don't get overwhelmed that कि बहुत सारे funds हैं. Actually, if you see, they are not too much. Another example, let me give you. Have you heard anyone that मैंने कोई गलत कार खरीद ली? कभी सुना है किसी से कि कार खरीद ली और 6 महीने का यार मैंने गलत कार खरीद ली? There are more than 1000 models of car, but when you buy a car, eventually you come down to maybe 2-3 models. अब 1200 या 1000 कार है, उसमें से आप नहीं बोलते अरे कौन सी खरीदनी है. यू डोंट सॉर्ट कि हाँ कौन सी बेस्ट है मेथोडिकली, एंड यू सेलेक्ट कि मेरा बजट इतना है, माइलेज मुझे ये देखना है, ये ब्रांड है, एंड इवेंचुअली यू नो कम डाउन टू 2-3 मॉडल्स और उसमें से आप सेलेक्ट करते हो. और वंस यू सेलेक्ट, यू नेवर से कि अरे गलत सेलेक्ट कर लिया. बट व्हेन यू कम टू म्यूचुअल फंड, the way we buy or the way we see mutual funds is completely different. तो हमको तो सिर्फ एक ही पता है रिटर्न्स, यू जस्ट सॉर्ट. अभी आप सिर्फ सॉर्ट करोगे तो डेफिनेटली बहुत सारे फंड्स आएंगे एंड यू विल गेट कंफ्यूज. सो देयर हैज टू बी अ सर्टेन मेथड थ्रू विच यू get into mutual fund.
What is that method and what are the four questions? So, car is a good example, but car I can connect to. I can see I like SUV, I like exactly color, I like exactly I want this is my budget. But mutual fund is something that people don't relate to like how they relate to cars, right? So, what are these 4-5 questions or things, factors that I should consider or any investor should consider to select their first 2-3 mutual funds?
So I have a very simple approach. Like car you said, you know, आपको माइलेज पता है, एसयूवी खरीदनी है. सो दीज आर वेरी ऑब्जेक्टिव थिंग्स. म्यूचुअल फंड में वी डोंट मेक अ लिस्ट ऑफ ऑल द ऑब्जेक्टिव थिंग्स दैट वी वांट बिफोर इन्वेस्टिंग, और इसीलिए वो प्रॉब्लम होता है. सो आई थिंक ऑफ अ वेरी सिंपल फ्रेमवर्क ऑफ टाइम, राइट? TIME, सिंपल. फर्स्ट इज टी, विच इज व्हाट इज योर टाइम होराइजन. आपको कितने टाइम के लिए पैसा डालना है, 1 साल के लिए डालना है, 3 साल के लिए डालना है, 10 साल के लिए. दैट इज फर्स्ट ऑब्जेक्टिव क्वेश्चन. एवरीवन विल हैव दैट आंसर. सेकंड इज व्हाट इज द इन्वेस्टमेंट ऑब्जेक्टिव दैट यू हैव. सिंपल भाषा में कि आपको क्यों इन्वेस्ट करना है. वेदर यू वांट टू प्रिजर्व द कैपिटल दैट यू हैव, प्रिजर्व द वेल्थ यू हैव, आपको वेल्थ क्रिएशन करना है, ज़्यादा रिटर्न बनाना है, या फिर आपको मे बी सिर्फ पार्क करना है 2-3 साल के लिए जिसमें आपको बहुत ज़्यादा रिस्क नहीं रहना. इन्वेस्टमेंट ऑब्जेक्टिव क्या है? यू गेट दीज टू आंसर. Then third is M, which is match these two objectives with the fund that you have. Now let me make it very simple. If your time horizon is say 5 years, right? तो इतने सारे जो फंड्स है उसमें से डेट फंड्स प्रॉब्ली आप निकाल दोगे कि 5 साल है, आपको मोस्ट लाइकली इन्वेस्टमेंट ऑब्जेक्टिव है कि थोड़ा बेटर एफडी से बेटर रिटर्न बनाना है. डेट फंड्स आपके बाहर निकल गए, बचे आपके इक्विटी फंड्स. Now if you are investing for the first time, definitely your investment objective will be not to take too much of risk, moderate risk, because आप संभल के पहले सीखोगे व्हाट इज इक्विटी मार्केट क्या है. तो उसमें बहुत सारे थीमेटिक फंड्स, सेक्टर फंड्स निकल गए. बचे आपके डाइवर्सिफाइड फंड्स, वेदर इट इज मल्टी कैप, फ्लेक्सी कैप, राइट? सो मैच द नीड with time horizon that you have and the investment objective that you have. Once you select a fund, तो बचेंगे आपके पास 20, 30, 40 फंड, उसमें से आपको सेलेक्ट करना है. एंड विल डिस्कस हाउ टू सेलेक्ट द राइट फंड ऑल्सो. लास्ट इज ई, विच इज मेंटेन इमोशनल बैलेंस. दैट इज मोस्ट important. And if you follow this simple approach, you can easily select 1 or 2, 3 funds, test your emotional balance over the next 3-4 years, understand more about it, and then deep dive into it. Swimming हम सीखते हैं ना, so पहले तो हम लोग हाथ पैर मारना, वो पकड़ के हाथ पैर मारते हैं. So it is like that. Mutual fund, the first step people want to take is select the right fund. That is the last step. First is start learning how to maintain emotional balance in this turbulent market. Markets will be turbulent. So first understand that, learn that, follow this approach, follow this framework to get into these 2-3 funds, check how your emotional behavior is, responses, and then get deep dive into it. तब फिर आप देखोगे कितने funds है, क्या है. It's like that.
Excellent. This is a wonderful framework. So we'll talk a little bit about equity funds. So I have large cap, mid cap, small cap. Be straightforward. Large cap is in stable large companies, mid-sized companies, small company. And suddenly I have a fund called large cap and mid cap. Yeah. Then I also have a flexi cap. So flexi cap, I can have access to all the 3 kinds of funds. Okay. So how do I sort that confusion? So if I can have access to all 3 categories of fund in flexi cap, then why should I go individually?
So as I said, you know, as a startup investor or a starting investor, if you see from a holistic point of view, large and mid cap, flexi cap, maybe a multi cap, most of these funds are same. Eventually, end of maybe 10 years, किसी का रिटर्न 19 है, किसी का 20 होगा. So for a first time investor, you won't find much of a difference between these 3 funds or maybe many other categories. But as you go forward, as you your corpus becomes large, it becomes essential to allocate some into maybe a flexi cap, which have some flexibility of maneuvering between large, mid, and small. Some into multi cap, which has static allocation between mid, large, and small. But initially, I don't think so. You need to get into कि flexi cap खरीदूं या multi cap खरीदूं या large and mid cap खरीदूं. The first important step is to select a good fund and start investing and let the compounding work. Now, say for example, you are an evolved investor and you want to understand what is large and mid cap, what is flexi, what is multi. So, eventually, if you see, these funds will have certain different allocation to large cap, mid cap, and small cap, and you can see through the portfolio. Now, if the tilt towards large cap is more, which most flexi cap funds today have, इसमें थोड़ा सा risk आपका balanced होता है. The moment you go into maybe a multi cap, you have almost 50% into mid and small cap. So definitely a risk is slightly higher because traditionally हमने वो सुना है, right, कि large caps are more stable companies. So they give you stable good returns, and they are resilient when markets are volatile. Mid caps are companies which are, just emerging. They are large in their sector, but, not one of the largest. So they are just building up their business. And small caps are very tiny businesses which probably have just started. They will have to see a lot of, turbulent times. So if you see, most large cap companies are there or exist for, decades or more than that. Mid cap and small cap, the lifespan, the history that we have is slightly shorter. So eventually, this mix becomes important for you to have that view कि मुझे कितना mid cap, small cap में डालना है या large cap में डालना है. So as I said, simple. As a starting investor, you select any of these funds. They are good. They are well diversified. Just keep investing and test your behavior, how you are behaving along with market. Are you taking any wrong decision, doing some mistakes? But broadly, 19-20 hai. There is no much difference into these three.
Why this question also becomes important is that there is another advice or general rule that you get to hear a lot on internet and from the advisors is that we should have 3, 4, 5 funds. You should not have a lot of funds, right? So then if when I'm building a good healthy meal, my core is protein. Okay, that's the major thing. And then I have carbs and then I have some salad, right? So if I'm having only 4 funds, what should be my base of 2 funds? First 2 funds that I should have. What should be the base of my portfolio then?
Right. See, one is if you are wanting to invest in equity per se, because base तो फिर आप debt equity भी होगा. Let's talk about आपको equity funds में invest करना है. I think so the first fund that you should have in your basket is an index fund. A simple large and mid cap index fund gives you exposure to top 250 companies of India. There is no rocket science in it. Just keep investing, just start investing in that. That is one fund. Second, because in India, we have seen fund managers generating lot of excess return, alpha over benchmark. एक आप कोई ढंग का फ्लेक्सी कैप फंड या लार्ज एंड मिड कैप या मल्टी कैप कोई भी हो, एक फंड वो आप ऐड कर सकते हैं. एंड विल कम टू दैट हाउ टू सेलेक्ट दोज एक्टिव फंड्स. एंड तीसरा, बिकॉज यू आर स्टार्टिंग your journey right now, this is your first step, maybe a hybrid fund or like a balance advantage fund will give you some stability to the portfolio. So ye teen fund can be part of your first step into investing. And if at all your time horizon is 5 years and 10 years, अगर उससे कम है तो ये 3 फंड नहीं लेने हैं आपको. Then there is another set of funds. लेकिन आपको 5 साल 10 साल के लिए स्टार्ट करना है, ये 3 फंड से स्टार्ट कीजिए. And I think so initially 3 to 5 years you don't need to think about anything else.
This is a good guidance for somebody who's starting. For let's say they build some corpus, some portfolio over a period of 3, 4, 5 years. And we are saying we should have 3, 4 funds. So then 2, 3 questions that I need help with. One is then, especially with new tax regime, does ELSs have any space now? Should people still consider it? Second is that when should I add another fund? And if I have to add another fund, what should be the thought process or criteria to add another fund?
So on ELSs, honestly, with the new tax regime and most people who are in the salary bracket of 10 to 12 lakhs it makes sense to get into new tax regime. In new tax regime, there is no benefit of ATC. So I think so ELSS from a taxation per se, I don't think so. Lot of new investors would be takers for it. But ELSS is a good category for someone who is very impulsive because वहाँ पे 3 साल का lock in है, right? If you are impulsive and you can react very quickly, क्या हो रहा है मार्केट में, क्या करूँ, आई थिंक सो ये लॉक इन बहुत अच्छे से काम करता है. यू स्टार्ट एन SIP, हर इंस्टॉलमेंट 3 साल लॉक इन हो रहा है. सो इवेंचुअली इफ यू आर इन्वेस्टिंग फॉर 3 years, 6 साल तक आपका लास्ट इंस्टॉलमेंट लॉक होता है. एंड इट्स अ गुड वे टू correct your behavior mistakes that may happen. But otherwise, from tax perspective, at least for new beginners and all, it may not make more sense. And we have seen generally flows typically from invest who want to take tax benefit. ELSS dire dire it has lost its shine actually.
So we have multi-cap, flexi-cap, and say balance advantage fund. I've been investing for 3, 4, 5 years. What should be the next fund, and why should I add a next fund? How should I look at the next fund?
See, eventually, if you are an investor, whether you are a beginner के लिए हमने बोला 3-4 फंड, 2-3 फंड से you can start. As you grow your portfolio, you need to diversify in terms of style, market cap, and if necessary, some other style like thematic and all. But eventually, आपको 6 से 7 फंड से ज़्यादा फंड नहीं चाहिए in any portfolio. Maybe you begin with an index fund, you have a diversified fund, maybe you have a hybrid fund. Then there could be a need to add maybe mid cap and small cap. So पहले मैंने नहीं बोला because mid cap and small cap, these segment are quite volatile. People get very excited looking at past returns. Today, if you see, the past returns are very, very good. But that may not be the case always. And we have seen mid caps and small cap for extended period, they have delivered lesser than even diversified fund. So one is you need to have that right emotional balance and risk appetite to invest in these funds and a time horizon and commitment to that time horizon, which is not less than 10 years. If you have that, I think so, then the next funds that you can add is maybe a good mid cap fund or a small cap fund. I think so, आपका core portfolio, 80-90% of the core portfolio can be in these categories of fund. Maybe you can add 1 or 2 mid cap fund, small cap में एक आपने maybe index fund भी choose कर दिया, mid and small में an active fund. कुल मिला के you don't need beyond 6-7 funds. That is 80-90% of your portfolio. Now उसके बाद में if you want to try some starters and all those things, maybe a dessert over your main lunch or dinner that you have on a daily basis, then you can add maybe thematic funds, maybe smart beta index funds, maybe international funds. But आप इन सब में चूज मत कीजिए. इसमें भी you will have to select because you can't have dessert also, you can't have छाछ also, you can't have salads also. Everything नहीं होता है. Side dish is meant for being side dish because if you start having each and every side dish, that becomes your main lunch or dinner. So maybe 1 or 2 flavor which you think you are comfortable with, maybe you understand risks about it, and then you can add any of these thematic, international funds, maybe smart beta index funds, any of these.
When I'm going to select another fund, lot of time I get to hear the question कि नया NFO आया अच्छा है क्या? Lot of time. So the question is, if I'm going to add a new fund to my portfolio, wouldn't it make sense to look from all the existing funds available where track record is there, performance is there,
Right.
portfolio is available, or should I go for an NFO? How do I make that choice that the next fund is going to be an NFO? You can answer it in 2 parts. One is when I'm selecting a new fund, should I look it from the existing this thing or an NFO? And if at all I have to select an NFO, how do I decide whether this is right for me?
See, NFO के अराउंड हम ना बहुत ड्रामा करते हैं. Whether it is NFO or whether it is existing fund, there exists a list of good funds, there exists a list of bad funds. Same way, there exists a list of bad NFOs, there exists a list of good NFOs. Let me take you back to the car example. Now, Maruti started with one model, which is Maruti 800 and maybe Maruti 1000. उसके बाद से आज तक they have maybe more than 20-25 models. Each model has come. We can't say it was bad or it was good, but if it matches your need and the changing environment of markets, you may buy it and you may choose not to buy it. It is up to you. Same way NFOs. So, AMCs are manufacturers. They will keep coming up with funds based on markets, right? 10 years back, the market dynamics were very different. The needs were different. Today, there is a huge listed universe in maybe some of the themes, maybe, digital, tech, जो पहले नहीं था, वहाँ पर funds आएंगे. There could be international funds, which maybe 20 years back weren't allowed in India. You need to select which one fits your bill. So, for instance, let's talk about a mainstream category in a mid cap. Now, if there is a new fund house who doesn't have a mid cap fund, they will definitely launch a mid cap fund. Doesn't mean that NFO है तो ये mid cap fund खराब है. No, it is a basic staple mid cap fund or maybe a multi cap fund. Now, you need to see whether it fits your approach, your objective, and whether selecting from an existing fund or an NFO, it is your choice. Now, let's talk about selecting a fund, right? For that, basically, I have a very simple framework. And if any fund, whether it is an NFO or existing fund, fits in that, I think so you should be fine. And I call it fit approach. Whether this fund is fit for your portfolio. What is fit? F basically stands for the fund house pedigree, which is very, very important. How the fund house has been, who are the managers, what has been their experience, check for any regulatory, violation that the fund management team has. So pedigree, the parent, the team becomes very, very important. Look at the fund house, how their other funds have done. It all comes under the fund house research that you can do. Second is investment team, which is very, very important. Uh, there will be processes, there will be, teams of research, there will be a fund manager, there will be a CIO. You need to see how this team has delivered across different cycles. Even if they are new in that fund house, they may have some experience in the past. You can definitely see the beauty of mutual fund is everything is in public, right? Daily NAV aati hai. Look at the investment team, how they how they have managed the funds, existing funds. And last is T, which is track record. A lot of people say key performance is not the indication, past performance is not the indication of future performance, but past performance talks a lot about many things. It is important because it tells you how the fund manager, the fund house has navigated the crisis, how the research team has come up with new stock ideas. Were they first to get these kind of or good performing stocks initially in their portfolio? Well, it all boils down to that, their ability to spot stocks, select sectors and generate alpha. ये past performance में ही दिखेगा आपको. But how do you see past performance is important. So FIT में the T is very, very important, but you don't see track record by just sorting the funds, right? Like I said, आप कार sort करके नहीं buy करते हो ना. There is a process. Same way, in track record, you look at rolling returns. Rolling returns are much better than discrete return. It tells you at different points in time whether the fund manager has been able to beat the benchmark, whether it is been able to be above average. Track record is very, very important.
So if you, can you talk a little bit more about rolling returns, how to look at that?
Sure.
Is it available?
Yes. So rolling return is simple. What is rolling return? So if you say are analyzing a fund and for last say 3 years, on a 1 year rolling basis, what has been the average return? Which means for last 3 years there will be at least 2 years where every day there will be a 1 year ka return track record, right? So on a rolling basis, what has been the average return, whether it is beating the benchmark for last 3 years. Same way, you can see 3-year rolling return for last say 10 years or 5 years. Give more importance for 3 years and 5 years rolling returns. Where do you find it? At Edelweiss MF, we give it on our website, on our product pages. In fact, we have just added a new feature on our category page where you can actually sort funds based on rolling returns, not their 1 year, 3-year return, which typically people do.
And is so let me clarify this. So typically the 1 year, 3 year, 5 year returns which is shown generally is from the inception of the product.
So it is basically from last 1 year. So today for any fund, if you're sorting maybe 10 funds based on last 1 year returns, which means till date, पिछले 1 साल से अभी तक क्या रिटर्न क्या है, दैट इज 1 year रिटर्न. 3 साल का अगर आप रिटर्न देख रहे हैं तो इट इज पॉइंट टू पॉइंट रिटर्न. सो 3 years बैक अगर किसी ने पैसा डाला होता है टिल डेट, व्हाट इज द रिटर्न. नाउ द प्रॉब्लम विद दिस इज last 3 years return can be very good, can look very good, even if your last 6 months returns in the market are very good. What is the problem with discrete return? The problem is in last 3 years, let's say 2 years, markets had given zero returns, right? But in last 1 year, markets have given probably maybe 50% returns. तो ये क्या होगा, इसका CAGR बन जाएगा और 3 year का रिटर्न यू विल फाइंड सम XYZ नंबर एंड यू फील कि पिछले 3 साल का रिटर्न है ये. 2 साल का जो अंडर परफॉर्मेंस था या फ्लैट रिटर्न था वो छुप गया. दैट इज द इशू विद डिस्क्रीट रिटर्न्स. In rolling, what happens? So this same fund, if you would have seen rolling returns, say 1 year rolling returns for last 3 years, क्या दिखा होता that initially the 1 year rolling returns were almost zero, probably negative also at some point in time, and last 1 year period में the rolling returns are very high. And when you average this out, the number will be much lower than the discrete 3-year returns which we are seeing. So lot of these anomalies of recency bias ये rolling return में चली जाती है. Hence look at rolling returns, it shows you how consistently that fund has given that particular return. So if rolling return आपका average 12-13% आ रहा है, which means there is a much better chance to earn that 12-13% returns versus a discrete return today which we are seeing on a 3-year basis which could be 20%, 23%. उससे expectation anchor करना is very, very dangerous. And in fact, we can do an entire podcast on what is rolling return and how to see it. I think so, with the advent of ChatGPT, आप simple एक डाल दोगे what is rolling return and how to see it. I think so it will give you a very detailed.
In nutshell, we should not be looking at discrete 1-3 year returns. We should look at
rolling returns,
which will give you average of that period.
Average
of just
absolutely.
Okay, great. So so you said F.I.T, which is fund manager,
So fund house,
fund
investment team and last is track record. So इसमें तीनों चीज आ जाती है. फंड मैनेजर, फंड मैनेजमेंट, फंड हाउस का पेडिग्री क्या है, हाउ दे आर मैनेजिंग द फंड. Investment team, their experience, their pedigree again, their ability to withstand volatile markets, how they have done in past, and last is track record of the fund or maybe fund house or of the fund manager in terms of numbers, which is rolling returns. You can see year on year, you can see how the fund had performed during COVID crash, look at volatility, a lot of these numbers.
There is another data that AMC keeps publishing, which is portfolio of a fund, which keeps getting published. Can you explain how to look at investor wants to? So expectation is the investor is looking at it, right? So what should they look into the portfolio of a fund that they have?
I don't think so. People should look at fund portfolios. That is not a job of the investor. Because अगर उसको portfolio देखना ही होता तो he could have invested directly. He could have made his own portfolio. The basic thing why people come to mutual fund is they don't have time to do all this, right? They have limited time to analyze which fund and all, but portfolio analyze आपको नहीं करना है. अगर आप किसी फंड में इन्वेस्ट कर रहे हो and you are required to do that work, then that's not the right fund for you. Okay, if you're doing for passion just to understand, that's okay. So that is one thing. Second is it is of no use because fund manager can change that portfolio any day. if you see on an average turnover, portfolio turnover, which means कितने जल्दी portfolio churn हो रहा है या change हो रहा है, on an average equity funds portfolio changes 50 to 60% in a year. So even if you see, अगर आपने portfolio देखा है और fund manager ने अगले महीने वो stock निकाल दिया है, it is of no use. Fund manager आपको पूछ के stock change नहीं करेगा. Maybe it can tell you what kind of investments he is doing, which sector he is overweight, underweight, just for your understanding. But it is not in your control. It can be a much more deeper analysis, maybe for evolved investors or maybe a distributor or an advisor who is helping. They should definitely do this to understand the way fund manager or the way fund manager style is, whether it is value style, growth style, all those. But for a retail investor, I think so it is too complex and it is not needed, honestly.
So then there is a very interesting question that I personally keep asking is that I agree with what you're saying is that we are not fund managers, we are investors, we have limited money that we are investing for returns and for our personal goals. Then how should they look at macroeconomics and all the things that people, so if you go to CNBC, you log into all the news channel, they always talk about macroeconomics and all of those things. So actually they are putting out that information and confusing people. So, people are talking about US tariffs, people are talking about small cap valuation, mid cap valuation. So I believe that as an investor I have given that job to the AMC to manage, right?
Right.
So should I look at it, or what's the right way to look at macroeconomics?
You can guess my answer.
Ah.
But let me take you back. 20 years back, having information was an edge. Today, the edge is to filter that information because there is a lot of information out there. And specifically, if someone is investing in mutual fund, there is no need to watch these channels. You know, uh, yes, there is need to gain some knowledge, some information, but too much information you won't be able to digest, and ultimately you will take a decision or take some actions which are not needed in your portfolio. I think so. And a lot of analysis are out there. Passive investors, and when I say passive investor, doesn't mean investing in passive funds. Passive investor is an investor who is not taking any action, who is just being more disciplined, beats an active investor hands down in any time horizon. Now, only thing is when you invest, when you buy that car, buy the correct car, buy the correct fund which meets your objective. वहाँ पे अगर गलती हो गई, तो then you'll have to keep checking कि क्या हो रहा है. So, say for instance, if you invest in a XYZ sector fund, you can't, go to sleep over it because you need to enter at the right time, you need to exit at the right time. Now, when to exit is a difficult question, but in a sector fund, it is the most important thing because 50% of the returns come in when you enter, and 50% of your returns would be decided when you exit. You need to book that profit. So, if you're investing in these kind of fund, best of luck, track the market, try to time it. But if you're investing in an index fund, a diversified equity fund, what you just need to do is just be more disciplined than your counterpart, and you can just beat him hands down.
Talking about this same stuff, there is a lot of talk about valuation of mid cap funds and small cap funds. Should I be worried about it, or it's okay? I have a long term horizon. I should be looking at the good mid cap and small cap funds.
Right.
How should I look at that?
So valuations, definitely you have to respect valuations because a lot of time we do say that time in the market is important, timing is not. But you know, to some extent, if you are better at timing also, and timing when I mean timing, it is in terms of valuation, looking at overheated markets. If you avoid those things, on an average, you would do much better in terms of return. So coming to large, mid, small valuation. So historically and theoretically, we have all learned that large caps, because they are more resilient, more stable businesses, usually trade at a premium. Mid
Before you answer this, simply if you can explain for the audience, what is valuation?
Right.
Yeah.
So valuation is one or two metrics that are most important metrics in valuation. One is price to earning and one is price to book. What is price to earning? So for example, if a company is earning a profit of say 100 rupees in a year, and if you are paying maybe 1000 rupees for that company as a price, you are buying the earnings of that company 10 times. 10 times that earning. You are paying 10 times that earning, right? If you are paying 100 times that earning, which means it's a 100 PE stock. Why do you pay? Because you assume that company will stay maybe for say 100 years, the terminal value and all is there. But you also assume that this 100 crore profit will grow at a certain rate, and at some point in time, I will start earning over and above the price that I've paid. So it's price to earning, and price to book is basically the book value of the company. Same logic applies. Now, most traditional way to view valuation is compare the price to earning between large cap segment, mid cap segment, and small cap segment. When you compare this at a segment level, historically we have seen large caps would have traded at a premium on an average, mid caps trade slightly at a discount to large cap, and small cap trades further at a discounted value. The reason is these are large caps are much more proven businesses. They are stable even during economic crisis. They are large conglomerates. They are diversified businesses. Mid caps, as opposed to large caps, maybe they are large businesses, but they are still in their phase, growth phase, where one or two things can go wrong. Small caps are just proving themselves, getting into new businesses. As they grow, they will also eventually become mid caps and large caps, and hence there is a discount for stability and maybe quality of those businesses. That's the traditional metrics. And at the segment level, so what happens, the issue is when, and historically we have seen that when mid caps and small cap, or generally when market is good, mid cap and small cap does very well. The reason is people feel और people hope that आज जो small cap है वो बड़ा होके mid cap बनेगा, large cap बनेगा. So let me catch this company at a very initial stage, because then your growth or the return would be much higher than large cap. And the issue happens when everyone starts believing in that story. Everyone up. There is simple demand and supply. And then there comes a time when reality strikes and they feel, okay, no, large caps are better because they are large businesses. Maybe 1 or 2 years of economic crisis, slow down, all this gets corrected. Hence, we see if you invest at a higher valuation, specifically in mid cap and small cap, the probability of you becoming successful or earning that returns, which historically we have seen, won't be true. So the better approach is either you invest when they are underperforming in general, whether it is mid cap and small cap, which means if they are underperforming, the valuations are low, you enter at the right time, and then you eventually earn a good return.
So, as on today, between these three categories, which is at the right valuation?
So valuation wise, definitely we have seen large caps, trading at the fair value or below fair value after recent correction. Mid caps are slightly overvalued compared to their historical valuation, and small caps also are highly valued. And we can just make out, over the last, say, since COVID, if you see, the index return of mid and small cap is almost 2x or 3x versus large cap, which is maybe 1.5x. Huge outperformance. So when this outperformance is there, obviously earnings growth have been good, but valuations are at a higher level.
So, should people enter at this point?
Yes, if you're investing for 10 years and investing through SIP, absolutely there is no issue, because SIP does that work of removing the timing thing from your investment journey. And even if they correct, you will get more units. So SIP, absolutely no issue. Even if you are investing at the peak of market cycle, when markets eventually fall, you get more units. So SIP is not an issue. In lump sum, if you are investing, you should, what you do when you invest at a higher valuation, one way to protect yourself is increase your time horizon. बिकॉज अगर आपने हाई वैल्यूएशन पे इन्वेस्ट किया तो अगले 1-2 साल में रिटर्न्स बनने की प्रोबेबिलिटी कम हो जाती है बिकॉज रिटर्न्स फ्रंट एंड हो जाते हैं. बट इफ यू इंक्रीज योर टाइम होराइजन टू मे बी 10 years, then absolutely it's good to invest. Then time plays its role. For instance, people who have invested at 2000 peak in mid caps and small cap, they've still made good returns. People who have invested in large cap also, they've still made good returns. In fact, mid cap, small cap returns are still higher than large cap from 2008 peak. So then you need to compensate of getting the timing wrong with the time. So timing and time can compensate each other. So if you get the timing right, maybe time is not so important to make good returns. You can make quick returns also. But if you are getting your timing wrong, then at least get your time right. They complement each other.
So
And when both these things come together, you get your timing right and you have good time also. I mean, then wonder happens. Then magic happens.
speaking about timing, there's a lot of talks about gold, that gold has given excellent return and everything. There's a lot of charts flowing. I have a different question. People are assuming that there is no risk in gold. Is that true? I mean, is just returns or there's no risk, or what do you want to say?
Absolutely no.
Hmm.
Uh, Gold, in a way, if you look at it in terms of standard deviations and all, probably it is slightly lesser than equity, but it is definitely a volatile asset class. और हमने देखा है years and years gold has also not given returns. And I won't say, I would never say that gold is not risky. Gold is equally risky as equity. When we look at portfolios, investment portion into gold is very limited, right? Most gold investment people do is in physical gold. And when you look at the way they, think about value of that gold, it is in years and decades, right? We talk about ये 10 साल पहले मैंने इतना गोल्ड लिया था, अब इतना वैल्यू हो गया. So over a 10-year period, you will never see that pinch of volatility, right? Whereas in mutual fund और equity markets या stock में हमने invest किया, अब हर एक घंटे में देखोगे तो आपको दिखेगा volatility. गोल्ड में हम नहीं देखते, रियल एस्टेट में तो और भी नहीं देखते. रियल एस्टेट इज ऑल्सो इक्वली वोलेटाइल. इफ यू पुट एनएवी चार्ट, वो भी उतना ही वोलेटाइल रहेगा. So people don't look at maybe gold prices too often in their portfolio. Also in their portfolio, most gold investment is physical gold, which is not valued on a daily basis. Hence, there could be a sense that it is not volatile. But when you look at numbers, gold is equally volatile.
So, would it be fair to say that over a long horizon, say 10 years, 15 years, equity has not made losses for people? It has been volatile. But if you hadn't stayed invested for, say, last 10 years, 15 years, you would have made decent returns
In equity,
in equity mutual funds.
yeah, so on a rolling basis, when we look at the probabilities of equity giving you positive returns, it is almost 99% on a 10-year basis. Rarely we have seen 10-year returns have gone, negative. It would have gone in maybe 2018 from 8 to 18, maybe, those point to point returns. Otherwise, on an average 10-year, you have very good probability to make positive returns on equity. On 5-year, you still have good probability, but lesser than 10 years. 3 years, 1 year, equity will be volatile. But 10 years, definitely, it has a very, very good probability to give you good positive returns.
So, with respect to portfolio, is it possible, or you can suggest, is that can I have my entire portfolio around mutual fund? What percentage of mutual fund should be part of my overall portfolio, of my overall investments?
See, again, the beauty of mutual fund is it gives you access to almost every asset class,
Mm.
barring maybe real estate. रियल एस्टेट में भी REITs in which आ रहा है. You will see, REIT in which focus mutual fund. But otherwise, it gives you exposure to gold in a very tax efficient way, at a very low cost. It gives you access to all kinds of equity, all segments of equity, all sectors within equity at a very minimal cost, managed by professionals. diversified equity. You can mix equity and debt in a much more tax efficient way, which you can't do it individually. It gives you access to international funds, international asset class. What else is left? So, in my view, if you want to create a portfolio, everything can sit in mutual fund. So for me, not because I've been in mutual fund industry or associated with it for last 2 decades, my entire portfolio, barring maybe physical gold which my wife would have, everything is mutual fund. So you can virtually uh, have everything done within mutual fund, and you don't need anything else beyond that. Yes, as you age, maybe for debt, you can see some small saving schemes which are much better for senior citizens and all. But when you are in your wealth creation journey mode, I think so mutual fund can take care of most of your needs.
Before I talk about debt fund, I wanted to close the equity bit. Uh, I was talking to a friend yesterday and I told him that I'm going to talk to you tomorrow. So he says I have 30 mutual funds in my portfolio. Okay. And I know I should not have it with as an advice. What should I do now? How do I, because if I take a cut now, I'll have to pay taxes and everything. So what would you recommend? And I'm sure there will be a lot of people who have 20, 15, 30, 40 mutual funds in their portfolio. How should they go? What should they do now?
See, first advice, and I would have only one advice to him: go to a mutual fund distributor or an advisor and get his portfolio checked and get it corrected. Don't do it yourself. DIY for such kind of investors is a very, very bad thing. To be a DIY, you need to be very, very disciplined. You need to give time. Only then you can do it. I'm sure he would have ended up with 30 funds, buying all of them or most of them himself.
So most of them are thematic funds
Absolutely.
and most of them are on the basis of performance.
So it is impulsive buying. I think so. One advice I would give him is see a good mutual fund distributor or an advisor. I don't have any advice because I don't have his portfolio in front of me.
But in terms of taxation, what would you say? I mean, it's not, I am not asking to give any advice, but in I was speaking to one of the guests. He said, you should take a tax cut.
Absolutely.
And you should if you pick up good 4 funds,
Yeah.
the return will be better than what you will get.
Absolutely. Your investment does not or should not be dependent on taxation. Taxation should be one of the criteria. But if you're getting into a wrong fund, then you should not wait for taxation and all those things. You just get rid of it and, change your portfolio, get into the right asset classes. Specifically, if you're getting into thematic funds, there are cases where markets have given you 13-14% returns, and thematic funds for 10 years have given zero returns, and not at one point in time, consistently. So if you're getting into a wrong theme, the negative alpha that you are generating in your portfolio is much higher than taxation you are trying to save or taxes you want to save. So I think so. You should just get rid of it. Don't think about taxation. Think more about wealth creation. How do you create wealth? If you create wealth, only then you will, pay taxes. By not creating wealth, then you are thinking about taxation. You are not doing anything and no justice on your portfolio at all.
So let's talk a little bit about debt funds. Since we can have you can have equity, gold, and debt. What amount of debt is advisable? And even debt also, there are multiple funds. So is it as simple as saying that basis your time horizon, you should pick debt funds? Like how should it? So again, I will go back to that basic framework of having 6 funds.
Right.
Okay, if I already selected 3, 4, 5 mutual funds, equity mutual funds, then how and when do I add debt fund? Which debt fund?
So debt funds are very important, and you know, uh, in a very plain or a simple way, everyone says if you're starting young, start with equity, but not necessary. If you are a 25-year-old, you have just started earning. You first start to save, right? Where do you save that money? You can't save that money in equity because as you age and as your lifestyle changes or life stages come in, like you want to buy a car, you are getting married, आपको 3, 4, 5 साल में पैसा लगेगा. Where do you save this money? You have to save in debt, you have to save in hybrids. So debt is very, very important. In fact, in my initial career, I had maybe 100 rupees ka SIP. I had almost 20% to 30% of that SIP in low duration funds, savings funds, because that gave me money to spend on whenever I was buying a car, I want to go out, maybe during my wedding, all those short term goals. And you will have a lot of short term goals in your 20s till 30s. So debt funds becomes very, very important there. Now coming to taxation or which funds. Now taxation has changed for debt funds, right?
Correct.
So initial in your career, definitely today, if you are in that 12.75 lakh tax bracket, you don't need to worry about taxation because it is at marginal rate. A lot of youngsters start earning maybe 7, 8 lakhs, 10 lakhs. Uh, they can easily invest in debt funds, any debt funds, maybe uh, a short-term fund or something where they can earn.
Just help me here. So there's this liquid fund. There is ultra short duration fund, low duration fund, saving funds.
Yes.
So between these four, how do I decide?
So basically, you see most investors in this segment are institutional investors, and they're designed to cater their liquidity needs, right? Liquid funds, 1 day liquidity, 3 day investments, or maybe a week investment is good for liquid. For most retail investors who want to save, I think so a low duration fund, maybe, or a short term fund is good enough. You don't need to go beyond these two funds. Start an SIP, keep saving into these funds if taxation is not an issue. So start with that. Don't get, again, as I said, overwhelmed with all these category. If you compare maybe return of a ultra short term or a low duration fund or a short term fund, maybe 50 bips over here and there over a long period of time. But any one of these categories are good.
So is it comparable to FD? How would you put FD and this low duration fund, short
Yeah.
duration fund?
So today, probably on a gross basis, the returns would be comparable. At times, it could be higher than FD also. But most important, it gives you a lot of flexibility, right? You can't do an SIP in FD and redeem it at one go. There will be penalties. You can do SIPs, you can do SWPs. On a day when market crashes, you can use this funds to switch to equities. So it gives you a lot of flexibility. So choose debt fund, not for just maybe 50 basis point higher returns, because that may not excite people, but for a lot of flexibility. And as I said, in the initial part of your career or life stage, you will need a lot of flexibility. You would need to spend that money, right? So liquid, or rather debt mutual funds, give you that flexibility, the power to spend or power to save the way you want. So some portion can be in FD if you're investing for maybe 2 years, 3 years, you are sure and you want to invest in that. FDs are also good. But if you're not sure and you are keeping emergency fund, you are saving it for a year or so, mutual funds give you that
So for
flexibility.
emergency fund, which fund would you say is decent fund to debt fund where you can use as a emergency fund?
Right. So emergency, as I said, short term funds or maybe low duration funds are very good. But again, if taxation is an issue, there are other beautiful categories like arbitrage fund. If someone is investing for maybe a short term and don't want to pay tax, maybe they are in 10, 20 or 30% tax bracket. Arbitrage fund is a beautiful category. It gives you debt fund like returns, risk free because it is pure equity arbitrage. And with equity taxation, you just need to pay 12.5 after a year. So arbitrage funds are good. If you're see a lot of emergency funds, you pile up your emergency fund for maybe years and years, you don't feel the need, right? And one day you will need, so liquidity is more important. Maybe equity savings fund also good fund to create a large corpus of your emergency fund, because emergency fund corpus may not be just 50,000, 1 lakh or 2 lakh. If it is that, maybe you can park in a low duration fund. But if it is large, in some cases it could be few lakhs or maybe 10 lakhs or maybe 6 months of your total income, You can also park it in equity savings fund where maybe 15-20% goes into equity, rest is arbitrage, remaining is debt, and it is much more tax efficient. If you're withdrawing after maybe 2 years or 3 years, you just need to pay 12.5% on your gains and get liquidity within 2 days. So initially, emergency fund, if it's a small corpus, if you're not worried about taxation, you are in that 12.75 lakh tax bracket. Uh, Maybe debt funds are great, low duration funds, maybe short term fund, nothing beyond that. And if you have a large corpus, taxation is an issue, arbitrage fund for very short term, and maybe emergency fund, which usually you don't need for years. You can also build a corpus in equity savings fund. So these four funds में आपका पूरा life sort हो जाएगा.
Okay, that's awesome. There's another very interesting thing you just said about switching from debt fund to equity fund when the market falls. So how does that work? So if I have parked my money in say low duration fund or maybe ultra duration fund, if market falls and I switch it on the same day, will I get the benefit of will I be able to capture that same days? Will it get transferred on the same day? How does it work?
So basically, this is much more nuanced question because if in debt fund, if you transfer to equity, you don't usually get the same day NAV because there are certain regulations of SEBI where you get the NAV only when the actual funds are available for fund manager to invest. In fact, today, in a lot of cases, if you even invest your SIPs on a particular day, you usually end up getting next day NAV. So, switching from debt to equity is not that you get that one day NAV, but over a period of time, if markets have been falling and you have some spare cash in your debt funds, you can keep investing. Because not everyone does an SIP. Not everyone will have that SIP installment hitting in the month of March when markets were down, right? But if you had some money in your debt funds, you could have switched it. Even if you get next day NAV, that entire month markets were down almost 6, 7, 8%. You still get that benefit. So in my personal portfolio, I always follow this 80-20 rule. 80% is in equity, 20% is in debt. And I do some SIPs into debt, whether it is arbitrage or anything, but it's broadly debt kind of money. And whenever markets keep falling every 5%, I switch some money from this 20% to equity. And this 20% gets refilled every month because some of my SIPs keep going into debt. So it gives me a good mental peace also. So I'm not worried कि market गिर रहा है. I'm just on the sideline, on the fence and watching it fall. When you have some money and you invest, you feel good about that fall also because I've been able to buy more units and average out my cost. So 80-20 rule is, worked very well for me. It gives me, peaceful sleep because market गिर भी रहा है तो I'm happy कि I have some money to invest when market is falling. And if it is going up, I'm still participating 80% to equity here. So it gives you a good balance.
So, can I also consider debt fund for a long duration, especially now that indexation benefit is not there, and
Yeah.
so
So as an asset allocation, if you want to keep that and you will need to keep some debt portion, as a part of your asset allocation when your, needs are there, then definitely debt fund can be invested for long
for a
term
long
also.
term, say if I want to say 5% or 10% of my portfolio in debt funds, which fund should I consider for horizon of 10 years? What are the options that I have?
So same, I think so. A low duration fund or a short term fund works very well even for maybe a 10-year time horizon. You don't need to get into maybe a fancy duration based funds because like we have thematic funds in equity which are cyclical, the similar of debt is high duration funds because you need to time them entry and exit, and in the long run probably they give you a similar experience but with much more volatility. So for retail investors, most invest I would say a short term fund even if you are investing for 10 years is very good. Now plus you have all these target maturity funds which work like fixed deposit. I think so you can just select which period or time horizon you want to invest for, and just invest and forget about it. So there are funds with 2033 maturity, 2037 maturity, 2030 maturity. You can just select them and be at peace.
When you say 2030 maturity,
So these are target maturity funds work like fixed deposit. So they have a certain time horizon. On that day they mature and you get back your money. So when I say 2033, which means there is a target maturity fund which is maturing in the year 2033.
oh, like that.
So you invest, they will mature, the proceeds will come back to you. In between, you can exit anytime because they work like an open-ended fund. So it gives you liquidity. In FD, if you want to redeem in between, your interest rate changes. It is much lower. Plus, you have to give penalty, all those sort of things. Here, you don't need to give anything. So those kind of funds are also there. But I think so for most investors, a plain short-term fund being part of the portfolio, even for long term, works very, very well.
So, I want to talk about a little bit about mindsets and the behavior that investors should, uh, consider so that they don't hurt their portfolios. What are the mistakes that people, or in your opinion, what are the things that hurts the portfolio performance the most?
Right. So the number one thing is selecting the fund based on sorting. I call them sorting investors. You go on the website, sort which are the top 3 funds, set an expectation कि मुझे इतना return मिलेगा and invest. That is the very first mistake lot of people do while selecting a fund. And we discuss how one should select. I think so if you follow that approach, you will be fine. Don't go with that. The second mistake is again linked to that everyone wants to have the best performing fund in their portfolio each and every time consistently. That's not possible. Take example of most best investors, whether it is Rakesh Chunchunwala in India, maybe we talk about many other investors. uh, no one would have all the best performing stocks in the portfolio at one point in time. The very essence of diversification, or the very essence of having multiple funds in your portfolio, is every time there is some or the other fund is outperforming and there is one fund which is underperforming, and they both complement each other, and that is where you create a diversified portfolio. Third is again setting wrong expectations, and if you do these 1 and 2 above in a wrong way, your expectations are always mismatched. You will always have wrong expectations. I think so these 3 are the most important things where people go wrong and they do big mistake. The another one which we discussed previously is people focus more on selecting the right fund or the best fund rather, uh, but they don't focus on learning how to behave in the market. Behavioral aspect they forget. बहुत ज़्यादा एनर्जी जाता है कि राइट फंड या बेस्ट फंड खरीदो, मोस्ट इम्पॉर्टेंटली बेस्ट फंड, बेस्ट परफॉर्मिंग फंड, and we give secondary, rather we don't think about being more disciplined in the market. So discipline actually trumps everything. A disciplined investor can actually trump an investor who is very, very high on IQ. A classic example of this is maybe a passive fund or maybe a passive index versus a active investor who's doing daily research and all. It is very hard to beat index, by the way, right? Fund managers manage it. Most fund managers in India over a long term has managed it. But for an average investor, it is very difficult. So what is index doing? Index is just being disciplined. Every 6 months, taking the top 100 stock and keep churning. Nothing else. Index knows only one thing, which is being disciplined in the approach versus an active investors. So most active investors, and there have been numerous studies, whether it is F&O investor, whether it is daily stock investors, most of them, 90% of them would have never beaten the benchmark.
Another thing that people ask about is when is the right time to exit a fund? Another way to ask this question is, if my fund is underperforming, what is the duration after which I should say, boss, now it's time to exit?
So first and foremost, you should exit fund when you need money, of course. The second is when you have a better investment opportunity. and you have found that one investment opportunity. And third is when it is underperforming. Now, underperforming is a very, very tricky thing, right? Any fund you take in India over a period of time would have struggled for some period of time, would have underperformed. People who have stayed invested, and if the fund manager is good, it would have reversed back and it would have given you good returns. So if you have done your homework right in that fit approach, then probably you don't need to worry about underperformance in that fund. Because if that fund is fitting in that fit framework, if it is fit to be in your portfolio even after underperformance, if the fund house pedigree is good, the fund management team is same, it has been consistent in the past, but it has been a recent underperformance, long track record in rolling returns in terms of consistency has been same, you don't need to. You can live with that underperformance for maybe 1 year, 2 years, or even 3 years. Okay. But if you have not done your homework right, and that fund is not fit, then definitely you need to get rid of it, and again follow the right approach and get into the right fund. So probably in terms of time horizon, 1 year underperformance is very, very usual. Never ever react to 1 year underperformance. 2 years is still okay. Done your homework right. So 3 year is alarming. 3 years you need to see whether you know why the underperformance is. And then probably in most cases, even after 3 years, if the fund is underperforming, it is better you change the fund to something else.
About the portfolio, okay, so we talked about that, we should start with 2 3 funds: equity, diversified fund, index fund, balance funds, and probably after 3 4 years I've added some more funds. Okay, I have 5 6 funds. Two questions: one is, at what frequency should I evaluate my portfolio? And when I'm evaluating my portfolio, how should I know that is on the right track, or I need to do something about it?
Yeah. So very good question. It is very important to review your portfolio. I think so. Once in 6 months is a good time horizon to review our portfolio. Three things which you need to review. One is the asset allocation, whether it is drifting because of market movements and all. You don't need to correct if it is drifting by 1 or 2% between debt and equity and all those things. But if it is drifting beyond 5%, then maybe you need to evaluate and see whether you need to rebalance it. Second thing is you need to see performance of the funds versus their benchmark. You don't need to see that whether your fund is still rank 1, 2, 3. That's not going to happen. That's the wrong expectation. Just check whether it is doing well over the last 2, 3 years versus benchmark. And third thing is basically, uh, do I have certain funds which I'm just holding because they are underperforming and they are losers? Because most people, the biggest mistake they do is, uh, if you want money, if you want to redeem, you redeem from your performing funds and you hold on to your laggards, and you feel कि ये हाँ कभी ना कभी वापस आ जाएगा. See whether you are holding on to these kind of laggards and remove them. I think so. If you do these three things on a 6 monthly basis, you should be fine, because it takes care of everything: your asset allocation, any underperforming fund, and everything else.
So, about the asset allocation, other than equity mutual funds and debt mutual funds, you are talking about overall portfolio also, right? So, what should it look like? So, all the options that I have, other than, uh, so you said you have 80/20 rule,
Yeah.
equity and debt. Is there anything else you consider in the portfolio? When you evaluate your portfolio, do you also look at NPS, EPF, all those stuff, or you're talking about portfolio only as an investment data?
See, broadly, NPS, your PF, these are very, very long term. You can't do anything even if you see on a 6 monthly basis. And that, I would say, is your asset allocation, strategic asset allocation, which will always be there. What you can change is only in your equity or maybe your debt mutual fund portfolio. But if you are a very hyperactive investor, you have thematic funds and all those, then you need to be more active. You need to see whether this theme has played out, whether I need to exit. So that is a very different thing. what I said is true for at least 95% of our investors. That 6 months में एक बार just check the funds, check the asset allocation. Also probably check once in a year that whether you need to increase your SIPs, whether you need to, whether they are keeping pace with the income increase that you would have had in the appraisals and all, basis the needs that you have. Increasing SIP is also very important because a lot of people, including me, humans are naturally lazy, right? You don't act. I have missed increasing my SIPs many times. So now I have made a thing that whenever I start an SIP, I go for top up. Simple. 5%, 10% every year. Automatically it keeps going on. So in my own example, I started SIPs in two funds almost 12, 13 years back. One was an index fund, one was an active fund. In index fund, I went for a top up, and in another fund, very good fund, top up nahi liya. But now I am regretting it because the amount I accumulated in that fund where I went for a top up is huge. और यहाँ पे भी I could have easily done, 500 rupees every year increase. 5,000 का वो कुछ 10-12 हज़ार हो गया है and the other one is just 5,000 only. So 12 साल पहले अगर करता, I think so it creates a huge impact. So that is one big mistake. You need to automate a lot of things. And in your review, if you see that I've not increased my SIPs and all, please do that. So once in a year you need to see that as well, how much you are allocating to your SIPs, how much you are committing to investments.
Generally, I don't cover market outlook. If you were to comment on current market basis, what is going on, how do you want the retail investor to think about it?
Right. See, one thing is, most important is set your expectations lower. Because when you set your expectation lower, two things will happen, right? One is you will not take impulsive decisions. You will not chuck out funds, or you will not give up your SIPs. You will not give up on investing just because your returns have not matched the expectation with which you have come. Because in last 6 months back till then, when I was speaking to investors, I think so 12-13% returns was very low for them. We were thinking 20-30% तो आराम से आ जाता है. So get your expectations right, lower them drastically. I think so you should be happy. You won't take impulsive decision. The second thing is that even if market gives you 13, 14, 15% returns over a long period of time, and which is realistic expectation, you'll be very happy. Because if you don't set your expectations lower, and eventually market will give that 12, 13, 15% returns only. If you don't set your expectation lower, you will be unhappy.
So in terms of expectation, what is a decent expectation or the right expectation from equity mutual funds?
From equities, it is very simple formula, right? Equity give you returns closer to earnings growth, and your earnings growth, companies ka earnings growth, are always closer to what is the nominal GDP growth in your country. Because generally prices move in tandem with your nominal GDP, your demand grows with that. Historically, if you see in last 30 years, equity returns are roughly around 14 odd percent. Earnings growth of Nifty 50 is also closer to 13.5, 14%. And your economic growth, GDP nominal growth, has been around 12%. So everything is aligned with that. Now, in today's context, India is growing maybe at 6-7%. That's a decent way, which is real GDP. You add maybe 4-5% inflation, it come down to maybe 12-13-12% odd. I think so that is the fair expectations to have at 12% returns over a longer period of time. Now there will be years when the returns could be 30%, but then eventually there will be also years where returns are lower. We saw after COVID 2 years returns were very good. Last year the returns were single digit. This year it could be negative, it could be positive. So eventually when I say 12%, it won't come every year 12% return. It is not an FD, right? On an average, there could be years which are much higher, there could be years which are much lower. But that's the right expectations to set.
And there are a lot of videos in internet, very, very bad headlines saying SIP is a scam. And I will play this video now. But there is this video on internet which says that you don't make money in SIP unless you invest in for 15 years or 20 years. But that's not the case, right? So I just want your perspective on how people should look at SIP.
Right. See, broadly, yes, SIP is for long term, but it is absolutely wrong to say that SIP doesn't make sense in short term. And we give a lot of emphasis to SIP. We should give emphasis to the right fund selection also. Right? There's no harm, as we discussed, of doing an SIP in a debt fund. Because the purpose of SIP is what? To get you disciplined and invest every month and save and set aside some amount. Now that SIP can be in a debt fund, and it completely makes sense to do an SIP for 1 or 2 years to set aside a corpus that you want to use after 2 years. Uh, if you're doing an SIP in a balanced advantage fund for 3 years or 5 years, it makes a lot of sense. It gives you very excellent returns. Uh, if you want to invest maybe in small cap and mid cap, you can invest for 7 to 10 years, you can make returns. So it is wrong to say that SIP is only for long run. SIP is a way of investing. If you want to invest for short term via SIP, select the right fund for short term for that time horizon, and you are absolutely fine to do SIP. So select the right fund, then see whether you can invest lump sum, because if you have money, you can invest lump sum. If you want to be disciplined and you want to create a corpus, set aside some money every month, go for SIP, and that is how it works. SIP is not a product. A lot of people think that SIP itself is a product, and I've heard this that no, mutual fund तो मैं नहीं करता हूँ, but मैं SIP करता हूँ. And I mean, I just laugh on that because SIP is a way of investing. If you select right fund, any time horizon is good for SIP.
Question, there's another question on the duration. Is there any scenario in which equity funds can also be considered for a shorter duration, say for 2 years, 3 years?
Right. So one is investing in a strategic way, right? Long term.
Yeah.
Most investors do it that way. Yes, for short term also you can invest, like thematic funds exist to take benefit of that one cycle, and those cycles come in short spurt. If you want to invest maybe in a manufacturing theme, for last 2-3 years it was great time for manufacturing, but whether it'll be same for next 10 years, 15 years, we don't know. Yes, manufacturing as a theme in India is going well, but that spurt of return which came in 2-3 years when government announced big things for manufacturing, that was a great period for manufacturing. And if you're able to spot coming heavily, uh, versus large cap, or markets have fallen heavily. Generally, we have seen when there is a huge fall in a year, the next 1 or 2 year returns usually bounce back. If you have that ability to take that risk, if you have that emotional balance to invest now and exit when markets start doing well or they are up, you can very well take those short term calls. But be aware that this is not the only way to invest. That is not probably the right way, but it is a tactical way to take benefit of these short term opportunities which can be taken via mutual fund. You need to be an informed investor to do that.
So, Niranjan, you are also writing a book, okay? Would you like to talk a little bit about your book and what is the message that you want to give to investors? And probably it'll be good way to conclude this podcast by what is the guiding principle for investing that I would like to tell people.
So of course you'll have to wait for some time, maybe probably 1 or 2 months to know more about this. So stay tuned. But the philosophy behind writing this book was, we Indians are great savers, but when it comes to investing, probably we are not that great. At the same time, it is not covering only investing. This book is basically covering all aspects of money, and probably it will have answers to all your questions uh, that can come in your money life, whether buying the right debt, investing, how to use credit cards, whether to take home loans, real estate, gold, everything. So stay tuned. See, about investing is basically start slow, learn the art of investing, controlling your behavior, and most importantly, be disciplined. The second important thing is, have some guidance along with you, because, investing is not a DIY art. It is not an experiment, because if you go wrong in that experiment, it will be very costly. And a lot of time there will be opportunity lost, which you even don't realize that you have lost that opportunity. And it's very heavy cost that you pay. So have a guide along with you, a mutual fund distributor or an advisor, and be disciplined. I think so. We make investing sound very complex, and probably we are also guilty at times because we talk about complex things. But investing is very simple. You just need to get into the right asset class, be disciplined, and have a guide with you. That's it.
So Niranjan, if somebody is invested in equity and equity mutual fund, it's fair to look at the long-term view and everything. If they have to track the market, what are the 2-3 things that they should be tracking on a weekly or monthly or quarterly basis in the market?
Right. So in the market, basically, see that one, you are not over invested in that equity as an asset class. That is first important thing. Second is, see which way the market is behaving, right? If market is, uh, giving you very high returns in the short term, that is a time when you make a lot of mistakes. There is quite of impulse to get into new funds, into new themes. So be more cautious when markets are doing extremely well. Be more cautious. So, it's basically being contra when things are on the right side. And uh, when things are bad, actually be more greedy. It's a natural rule. So that's the second thing. And third is, keep an eye on the fund that you are invested in. And we spoke about how to review them. So once in 6 months, see that whether these funds are beating the benchmark on a long term basis. uh, there is no, sudden underperformance or so. I think so these three things, if you track, I think so you should be fine over the long period of time.
Thank you, Niranjan.
Thanks, Bhartendra.